Ladies and gentlemen, let me begin with a simple truth. Every generation believes their financial system is permanent until the moment it breaks. And when it breaks, people look back and realize the signs were always there. Obvious, visible, undeniable, but ignored because they were inconvenient. Today, I want to walk you through something that is not speculation, not sensationalism, but a mechanical outcome of how debt cycles and monetary systems always behave. We are heading toward a moment when the Federal Reserve will be forced into a massive gold revaluation, not because they want to, but because the math leaves no alternative. And when you see the math clearly, 147,000 gold is not extreme. It is the equilibrium price required to restore balance. Every major debt cycle reaches a point where the existing system can no longer sustain itself. And when that moment arrives, the response from policymakers is almost always the same. They reset the currency and revalue gold to restore balance. This isn't a theory or an opinion. It's the observable pattern that has repeated itself through centuries of monetary evolution. When you zoom out far enough and look at long-term cycles instead of short-term market movements, the logic becomes straightforward. Debt grows faster than income, obligations compound beyond the economy's capacity to service them, and governments are forced into choices that ultimately dilute the currency. Gold, being the only widely accepted monetary asset without counterparty risk, becomes the stabilizing mechanism that resets the system. When countries accumulate too much debt relative to their productive output, they face the same dilemma every time. They can either allow defaults to ripple through the system, erasing wealth, destroying confidence, and triggering social unrest, or they can choose the historically preferred option, devalue the currency. Devaluation is far more politically tolerable because it spreads the losses subtly across the entire population through inflation rather than imposing them directly on specific institutions or individuals. But devaluation alone isn't enough. For the new monetary system to regain trust, it requires an anchor, something that cannot be created out of thin air. That anchor has always been gold. In every large debt cycle, whether it was the early European banking systems, the British pound's decline, or the multiple transitions of the US dollar, gold served as the reset button. When the currency weakens to the point where it loses credibility, policymakers revalue gold at a much higher price to match the new level of money supply and debt. This gives the illusion of stability without explicitly calling it a default. A higher gold price strengthens central bank balance sheets, restores confidence, and allows the financial system to begin again from a recalibrated base. Take the United States in the early 1930s. The government had issued far more claims on gold than it possessed. Confidence was evaporating. Rather than allow a cascade of bank failures, the government simply changed the rules, seizing domestic gold and revaluing it from $20.67 to $35 per ounce. That revaluation increased the dollar value of gold on the Federal Reserve's balance sheet by nearly 70%, instantly recapitalizing the system. The same pattern appeared again in 1971 when the dollar's link to gold became untenable. Foreign governments were asking for gold in exchange for their dollars, and the U.S. didn't have enough to meet the claims. Closing the gold window and allowing the price to float was another form of reset, one that resulted in gold rising more than 20-fold in the decade that followed. These are not random events. They represent the mechanical responses available to policymakers when debt overwhelms the currency. The reason gold always plays a central role is because it cannot be printed, manipulated, or promised into existence. It forces honesty into the system. Whenever trust evaporates, the world returns to something that is universally accepted, scarce, and independent of political control. That is why gold has survived every empire, every currency, and every financial experiment. Today, the conditions resemble previous turning points. Debt levels are historically high, real interest rates are deeply negative, fiscal deficits are structural, and monetary policy has reached diminishing returns. Central banks around the world are accumulating gold at the fastest pace in modern history, not because it earns a yield or because it's fashionable, but because they understand the end of a long-term debt cycle when they see one. They are preparing for a future in which currencies must once again be rebalanced against real assets. The inevitability of this process doesn't come from ideology, it comes from arithmetic. When liabilities exceed the real value of the currency, something must give. Historically, what gives is the currency itself. And when a new monetary structure needs credibility, gold is revalued to provide it. The pattern has been consistent for centuries, and the forces driving it today are stronger than ever. The cycle is repeating, and the world is quietly moving toward another reset where gold plays its traditional role, not as a speculative asset, but as the foundation that restores balance when the financial system becomes unbalanced beyond repair. The U.S. debt structure has reached a stage where the numbers no longer operate within the boundaries of a normal economic cycle. The system now behaves like a late-stage debt cycle where obligations expand faster than the income needed to service them. When debt grows at a rate that exceeds productivity and real economic output, the usual tools, raising interest rates, cutting spending, or increasing taxes, stop being politically or economically viable. What remains is the same mechanism that has emerged in every major monetary transition, repricing the currency and repricing the asset that supports confidence in the system. Under current conditions, that asset is gold, and the repricing is not a matter of if, but a matter of when. The debt structure itself tells the story. The United States carries tens of trillions in public debt, but that's only the visible layer. When you include unfunded liabilities, future promises like Social Security, Medicare, and pension obligations, the total obligations stretch far beyond what the tax base or the productive economy can realistically support. At the same time, political incentives make meaningful austerity impossible. No modern democracy willingly reduces benefits or increases taxes to the level required to balance the books. The result is a continuation of borrowing, rolling over old debt with new debt, and hoping growth eventually catches up. But when debt reaches a certain size relative to income, history shows that it never catches up. The gap widens, and policymakers quietly prepare the only solution that has worked across centuries: currency debasement. Negative real interest rates accelerate this dynamic. When inflation runs above the nominal interest rate, it means the real value of government debt is being eroded. This is intentional. It's a hidden tax on savers and bondholders, allowing the government to reduce its debt burden over time without formally defaulting. But this process comes with consequences. When the real return on cash and bonds is negative for long enough, people begin to look for alternatives. Capital flows toward scarce assets, land, commodities, and historically, gold. At the same time, the central bank becomes trapped. If it raises interest rates high enough to restore positive real returns, it risks destabilizing the entire financial system by making the debt unserviceable. If it keeps rates low, it accelerates the erosion of purchasing power and undermines confidence in the currency. This is the classic late cycle dilemma. Fiscal deficits compound the pressure. When a government consistently spends more than it earns, it must issue more debt. When the deficits become structural, not cyclical, the borrowing becomes permanent. And when the deficits grow faster than the economy, the currency tied to that system eventually weakens. The U.S. now running deficits so large that even optimistic growth projections cannot close the gap. The only way to sustain this pattern is through continual expansion of the money supply and continued monetization of debt. Dilutes the currency over time, and the market eventually demands a repricing of real assets to compensate. This is where gold fits into the equation. Gold is not rising because investors are emotional or because markets are irrational. Gold rises in these periods because it is the only monetary asset that does not require someone else's liability to function. It doesn't depend on a government promise, a central bank balance sheet, or a political decision. As the currency is weakened to accommodate the debt, gold naturally reprices upward to reflect the new value of money. In previous cycles, the repricing has been dramatic because the gap between the real obligations and the real value of the currency was large. Today, that gap is larger than any point in modern history. Central banks understand this reality clearly. Their actions speak louder than any political statement. When central banks accumulate gold aggressively, they are preparing for a future in which their own currencies must be reinsured to something with intrinsic credibility. They recognize that the combination of enormous debt burdens, structurally negative real rates, and persistent deficits leads to the same conclusion every time: the currency must be devalued and gold must be revalued. The inevitability comes from the structure of the system itself. A financial system built on debt cannot resolve imbalances through growth alone when the numbers reach this scale. Inflation, currency dilution, and repricing of real assets become the release valves that prevent collapse. Gold's role in this process is mechanical. It becomes the benchmark against which the weakened currency is measured. The larger the imbalance, the higher gold must be priced to restore stability. In this environment, a massive gold repricing is not a radical forecast. It is the logical endpoint of the forces already in motion. A gold price of 147,000 sounds extreme only when viewed through the lens of the current system, but when you step back and analyze how monetary structures function in late-stage debt cycles, it becomes clear that this number isn't a prediction. It's a calculation. Every monetary system requires enough real collateral to support the claims built on top of it. When those claims, government liabilities, currency supply, and future obligations grow far beyond the underlying reserves, the system becomes unbalanced. Historically, the way balance is restored is through a large-scale repricing of the reserve asset. In modern financial architecture, that anchor is gold. And when you divide total liabilities by actual gold reserves, the necessary price to restore equilibrium reaches levels that, on the surface, seem impossible, but mathematically are unavoidable. The reason this price level emerges is because the relationship between debt and GDP has reached a structural breaking point. When a nation accumulates debt faster than it grows its income, it eventually arrives at a place where the debt can't be paid back in real terms. The only remaining path is to reduce the real value of the debt through currency debasement. Debasing the currency requires a reference point, something real, scarce, and trusted. Gold has played this role for thousands of years because it cannot be manufactured, manipulated, or created through policy decisions. It acts as a neutral yardstick. When the currency weakens, gold doesn't change. The currency's value changes relative to it. That's why in every historical debt reset, gold is repriced sharply higher. The system requires it to maintain credibility. The key to understanding the 147,000 figure lies in the scale of today's imbalance. The United States holds a finite amount of gold, yet it has created claims through debt, unfunded liabilities, and money supply expansion that are many multiples larger. If the system were forced to mark its balance sheets to a hard asset, the gap would be enormous. That gap is what the gold price must fill. In the same way, a company with insufficient assets must revalue its inventory during restructuring. A nation in a deep debt cycle must revalue its reserves. This is what happened in 1933 when the U.S. raised the gold price from $20.67 to $35 to recapitalize the Federal Reserve. It wasn't about speculation. It was an accounting necessity. And the same principle applied in the 1970s when gold was effectively revalued upward by the market after the dollar was detached from the metal. When you run the math based on today's obligations, the numbers are staggering. You take the total liabilities, public debt, unfunded entitlement programs, central bank balance sheet exposures, and compare them with the roughly 100 tons of gold officially held. To back those claims at even a modest coverage ratio requires a gold price far above anything discussed in mainstream circles. A price near 147,000 per ounce isn't ambitious. It simply represents what gold would need to be valued at if it were to restore solvency across the system in real terms. This is why the number keeps appearing in analysis that trace the mechanics of debt cycles and currency devaluations. The mathematics behind this process are indifferent to political debate or economic optimism. That cannot be repaid in real terms will not be repaid. It can only be inflated away. Inflating away debt means weakening the currency. And weakening the currency requires a compensating rise in the asset used to anchor it. For centuries, gold has served that function because it sits outside the financial system, cannot be defaulted on, and carries no counterparty risk. When too many claims exist relative to real assets, the real asset must be revalued. The larger the imbalance, the larger the revaluation. Price level also becomes more plausible when considering what central banks are doing rather than what they are saying. Their accumulation of gold signals a clear understanding of the structural pressures. They are preparing for a period when currencies will be forced to reset to a new benchmark. And when that reset happens, it won't be based on sentiment. It will be based on the arithmetic of liabilities. A price of $147,000 is not about gold becoming worth more. It's about the currency becoming worth less. It's about adjusting the valuation of the only neutral asset in a system flooded with leverage. Once debt expands beyond the capacity of GDP to support it, the final adjustment is always the same, a repricing of the reserve asset to absorb the excess. Viewed from this perspective, the number isn't extreme. It's the logical resolution of a cycle that has already unfolded many times throughout history. Understanding this transition early isn't about predicting the future, about recognizing the structural forces already in motion and seeing where they inevitably lead. Throughout history, the people who preserved and expanded their wealth during major monetary shifts were not the ones who reacted after the system broke. They were the ones who observed the signals, connected the dots, and positioned themselves before the rest of the world understood what was happening. Wealth doesn't disappear during these transitions. It simply moves. And it moves from those holding assets tied to a weakening currency toward those holding assets that retain purchasing power when the currency loses its value. The core idea is simple. When a currency loses purchasing power, everything priced in that currency adjusts accordingly. But the adjustment is not uniform. Some assets fall, some stagnate, and others rise dramatically. The key is to understand which assets benefit from the environment created by excessive debt, negative real interest rates, and structural deficits. Historically, the winners in these environments are assets that do not depend on a promise, a policy decision, or a government guarantee. They are assets with intrinsic value, assets that survive both inflationary and deflationary shocks. The most consistent among them has always been gold, not because of mythology or ideology, because of its role in the monetary system as the ultimate store of value. When currencies weaken, they don't do so in a straight line. They lose credibility slowly, then suddenly. People continue to trust them for years, sometimes decades, until the gap between real economic value and financial claims becomes too large to ignore. Then the adjustment happens quickly. In that moment, those who hold cash or cash-like assets find their purchasing power diminished, sometimes dramatically. Meanwhile, those who understood the direction of the cycle appear almost lucky, even though luck had little to do with it. They simply position themselves where the cycle was heading. The shift that is unfolding today is not unique. It mirrors previous long-term debt cycles where excessive borrowing forced governments to rely on inflation and currency devaluation to manage their obligations. In those periods, financial assets denominated in weakening currency lose value in real terms, even if their nominal prices rise. The illusion of wealth remains on paper, but the reality is different. The cost of goods, services, and real assets outpaces the gains. That's why understanding the transition early is so important. It allows individuals to convert weakening money into stronger stores of value before the repricing takes place. Positioning early also protects individuals from the psychological pressures that accompany monetary transitions. When the adjustment begins, most people panic or deny what's happening because they're anchored to the old system. They trust that policymakers will fix the problems without consequence. They believe inflation is temporary. They assume the currency will recover. They wait, and waiting is the most expensive decision in these periods. Those who understand the transition see through the noise. They focus on long-term forces rather than short-term narratives, and they position themselves accordingly. This positioning isn't only about holding gold or other hard assets. It's also about understanding how wealth behaves in an environment where purchasing power erodes. It involves thinking in terms of real returns, not nominal ones. It requires measuring assets against what they can buy, not what they appear to be worth on paper. It means recognizing that during currency transitions, wealth is transferred silently. No announcement is made. No warning is given. The transition happens through shifts in prices, changes in incentives, and the gradual erosion of cash's usefulness as a store of value. Individuals who internalize this reality early are able to act without emotion. They see the currency losing purchasing power, and they adjust. They move away from assets dependent on financial engineering and toward assets supported by real scarcity. They diversify across systems, geographies, and stores of value that don't rely on the integrity of a single currency. They protect themselves not because they are fearful, but because they understand the mechanics of the cycle. The greatest advantage one can have in a major monetary transition is clarity. Clarity comes from studying how these cycles have unfolded countless times before. And once the pattern is clear, the moves become obvious. Those who understand early position themselves on the right side of history, on the side where purchasing power is preserved, not diluted. They step into the next system from a position of strength, not desperation. They don't just survive the transition, they benefit from it. Let me end with this. The people who understand what's coming are not loud. They're not emotional. They're not trying to predict the future. They're simply reading the cycle. The same cycle that has repeated for centuries. And the cycle is telling us this: a currency era is ending. A new monetary framework is taking form, and gold will be repriced to reflect the true scale of today's debt-based system. The question is not whether the reset happens. The question is whether you understand it before everyone else does. Because when the world wakes up to what 147,000 gold represents, the opportunity to prepare will already be gone.